Good afternoon, everybody. Welcome to Selecting an Option Strategy. I'm Connie Hill. Every week we get together at this time and kind of discuss what's going on in the market and see maybe what kind of strategies might work in that type of a market. Although doesn't mean it's definitive by any means. I'm glad that you joined me here today, and I see lots of familiar names: Lola, David, Kevin, Tony, Ricebird, Nash, Chris B, and the gang. Appreciate you being here. I'm also joined in the chat today by Cameron May. Cameron's here to maybe help fill some questions I can't quite get to in the course of our discussion here today. As you have questions, go ahead and chat them in. I will keep an eye on that. Cameron will be watching for that as well, and we want you to get your questions answered. Just those of you that are listening to this on the archives, like I know lots of you do, when you have questions, put your questions in the comments section of YouTube, because as coaches, we go back and review those throughout the day. We want to make sure that you get your questions answered here as well. Now, I do hope you're following us on X. It's free and easy to do. I'm on X as Connie Hill CS. Cameron is on as Cameron May CS. We'll post educational content, sometimes graphs or things we're seeing in the market or things we might have a question about that we think you might find interesting. We'll go ahead and post about them. So feel free to join us. Let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes. Don't consider it a recommendation. We will be using the Paper Money software application. It's what you download to your computer. It's the most robust version of Thinkorswim. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. We talk probabilities in this class. Keep in mind that probabilities are theoretical in nature and never guaranteed. There is no guarantee that an execution of a stop order will be at or near the actual stop trigger price. All right. Upcoming workshops. We've been kind of informing you about them so that if you want to go, you can get registered early because they fill up quickly. All right. So you guys kind of get the upper hand here. We've got Chicago in August, Washington, D.C. I'm sorry, my little Washington, D.C. was chopped apart. I thought I fixed that. In September, and Dallas, September 20th. So would love to see you there. And I know several of you have taken advantage of that opportunity and have really enjoyed it. So very good. In this webcast, we take a look at market conditions, and something I'm wondering, and I'm going to ask you here, and feel free to respond in the chat. I'd love you to. Are you feeling maybe there's some changing going on in the air? Okay. Now around here, it's still pretty hot. We're in late July, which is, I think, our hottest month. But when we get to August, temperatures start to cool down a little bit, and you kind of feel little rustlings of a change. And so could it be that we're maybe feeling or sensing some sort of a thing like that in our markets? We're going to take a look at that, all right, today, and discuss what option strategies might work best in those circumstances. We're going to always look at previous examples and follow up on some trades, and we have a little bit of follow-up discussion to have here today before we put on some new example trades. So let's head over to Thinkorswim, and we can start here on the Russell 2000. This is the index that tracks the small cap stocks, right? And it hasn't been quite as strong as the S&P and the NASDAQ in the sense that it hasn't been putting in new highs, say this week and last week, but it did put in a new high. I guess this was last week on July 10th, or maybe a couple of weeks ago. It had a nice new little high here. And it's still above this blue 10-day moving average. And there's a 5-day moving average. And it's a little wonky. Let me fix something here. I am going to turn my tools off, and then I'm going to turn them back on, see if that clears up the issue that I was having here. Okay, that's better. One thing I want you to notice on the Russell 2000, and this is probably the most prominent index we're seeing this on, is we're starting to see a little bit of a divergence develop. in that as the price action goes higher and higher, we expect the oscillators to go higher and higher as well. So if we've got a MACD or a stochastic, or in this case, I put on the RSI, it's has a tendency to be known for being good at identifying divergences. We can see the peaks here on the RSI. What direction are they going? All right, yeah, the peaks are getting a little bit lower and a little bit lower, even though the price is getting a little bit higher, maybe a little bit higher. So we don't want to see that. Or when we do, it's an indication that perhaps things are changing. It doesn't mean they absolutely will, but it's kind of maybe like a little yellow flag, like kind of getting our attention. Maybe something's going on here, but we wait for price to really confirm that that's the case. Now, if we look at the Dow Jones, on our Dow Jones, it made a high a couple weeks ago here as well. But can you see these lower peaks? There's lower peak, lower peak, lower peak, lower peak. Okay. Maybe things are starting to change. You know, as you look at the price action here on the Dow, these peaks are getting a little bit lower as well. So in reality, the RSI is corresponding to the heights of the Dow in that they're both a little bit lower and a little bit lower instead of churning higher. Now let's look at the SPX. That usually is a good broader gauge of the market of what we're looking at here, right? 500 big stocks as opposed to maybe the small cap stocks or the 30 stocks on the Dow Jones. So yesterday it put in another new high, all-time high. And we've been seeing that day after day. We've been seeing it just churn a little bit higher and churn a little bit more. Although I would say maybe this is starting to get a little bit more sideways. And then here on the RSI, if we were to connect these dots, they were getting a little bit lower, but then just recently, this one did go up a little bit higher than this previous peak here. So it's kind of like, well, it started to diverge and now maybe it's straightening out. So maybe it's not quite as weak as what we thought. And if we come over here to the NASDAQ, take a look at it, it's again putting out a higher high, just barely as it churns along. The one thing about the NASDAQ, though, is look at it, how strong its RSI is. It's stronger than what we were seeing on the Dow or the Russell 2000, where we can see, oh, yeah, made a new high. Good. It was above the RSI 70 line there, put in a high, and then it put in a higher high there yesterday. So I'm going to remove that line there that looked like a divergence was maybe starting to form, because it doesn't look like it's intact anymore. Okay, so of our indexes, maybe some of them starting to show some weakness, maybe others like the NDX and the SPX, maybe a little bit stronger. And if we come over here and look at the VIX, well, I have to type it in correctly, first of all. On our volatility index, let's see what the markets ended up. Looks like the Dow ended up, the Russell ended up, the S&P ended down slightly as well as the NASDAQ. But the volatility index here, which is this one's really tracking the S&P 500, looks like it dropped a little bit, right? It's down, and it has been down in this lower area where maybe not a lot of fear is taking place. So we have a little bit still more churning in the markets, maybe some weakness creeping into parts of the market. How might that influence you as a trader on what strategies you think you might want to look at? So like if I asked you right now, based on everything we've talked about up to this point, what types of strategies do you think would be most beneficial in this kind of an environment that maybe meet weaknesses heading in the Dow Jones and the Russell 2000, but not so much on the NASDAQ and the SPX? Feel free to chat that in. I would be interested to see what your thoughts are here. Let's do this. Let's jump back to our slides here, because let's talk about what strategies we might consider. Now, we really have not done very much by way of the bear strategies here in the last few months. We really haven't done too much with them because the market kept putting in new highs, and again, put 2 new highs in yesterday. So we really haven't had much opportunity here. We have spent some time on bullish strategies. a lot of time. Last week, we put our toe in a couple of potentially neutral strategies because we were doing some earnings trades, which we're going to follow up on. We did one iron condor, we did one straddle. And they were for the purpose of seeing if we could take advantage of what was going on with earnings. I'll show you how those fared for us. As you're looking, Will says, maybe we've got a coiling cobra going on where the market's just kind of tightening up, getting ready to maybe not jump out, but kind of spring out. That very well could be the big case. Chris is doing a wait and see strategy. Okay, meaning not so convinced, so you're not rushing into anything is how I'm going to interpret that for you, Chris. Ricebird's doing a long, say maybe long puts, might be appropriate for what you're looking at. Vic says sideways to neutral positions. Protective puts, says Tony, yeah, all of those could be things that we might want to be thinking about. If we think maybe there are some winds of change going on here. I like all of your thoughts. They're very good. And I would say most of them are not like looking for big market moves, but let's see what the market's doing. Being a little hesitant, being a little protective of what might be going on. And there could be some positions that maybe you're up in really nicely that maybe you do want to do some protective puts, like Tony suggested. That very well could be the case. I want to do a little bit of follow-up on a couple, actually several of our trades. I don't want to spend most of our time there, but I do need to spend a little bit of time here because we need to do some follow-up. First thing I want to look at is, let me get rid of the color. The first thing I want to look at here, Wells Fargo, WFC. Wells Fargo, we had done 2 trades doing what we called a 520 crossover, where we had observed the 5, which is this purple line crossing above the 20, which is this teal blue line. And the idea was we stay in the trade as long as that 5 stays above, they don't cross again. As long as that 5 stays above the 20, we stay in the trade. Guess what happened yesterday? Yesterday, at the close of the day, they crossed. It was really close here, not quite crossing, but right here, we see that purplish, pinkish line cross down below the 20. What does that mean? It means an exit. So I had to close out of it today. Now, with a 520 crossover, you could use stocks if you wanted to. In our case, we used a longer dated options. I think it was a January date. We'll take a look here. On Wells Fargo, because I went ahead and I had to close it out. And so, yeah, it was a January option. It's showing us here, we got 1095. No, that was the mark price. Let's see. I think we got filled at $11 even on that one. So we bought it for $8.95. We closed it for $11 earlier today for a gain of $205 or $205. Doesn't include commissions. So not a huge big winner, more like a small base hit type of thing. More than anything in that particular lesson, I just wanted to kind of expose you to the strategy of looking at moving average crossovers as something to consider for some of the things that you like to trade. We hadn't had a chance to really touch on it in this class, and so I wanted to take some time to do it. So that's kind of where it made out. Now, had we been in a stock, I imagine it might have been fairly similar, okay, because the stock isn't a ton higher than where it was when we got in. By that longer dated option, we didn't really experience a lot of time decay. Okay, let's take a look at GM. We did 2 stocks. We were talking about the covered call strategies, and so we did this a little bit ago. And one of the stocks that we just bought some shares on so we could practice our covered calls was GM. And GM, maybe let's give us a 6-month look here. This is when we got into GM. We were not worried about the 5 and the 20 moving averages on this particular trade, but I'll just leave those up there. We can see that it started making some higher highs and higher lows and kind of going a little bit sideways, okay? We went ahead and purchased the stock, and then we sold calls against it. Might have done it a couple of times. The most recent time was right here. And we sold on GM, we sold a call for $1.46. Okay, so on a 50-ish price stock, bringing in $1, almost $1.50 at $1.46. We brought in that premium, and it kind of helped weather the storm when it just kind of was going sideways here and not doing a whole lot. Sometimes people might like to hold calls over an earnings report for some protection if they want to. Sometimes it can work against you, right? Because your gain is capped, and if it were to pop up, it might not have helped us all that much. But today, with this thing dropping dramatically, that option really helped us. So we went and bought it back for much smaller amount, 19 cents. We collected 146 in the beginning. We bought it back for 19 cents, leaving us a net of 127, which helped offset for the price of the stock, because we got the price of the stock. Let's open that up here at $49.76. Price of the stock's a little bit lower here. And so we're seeing, after having bought that back, we're seeing a little bit of a negative on that position before we bought it back. It actually was showing a little bit positive, showing how much that had helped. And a lot of that came today when the stock dropped. Now, the question is, should we still be in the trade? Okay, we bought it, to use for our example, to use for covered calls. But if this is if this is a hold for you, say we're in your portfolio, would you still want to be in the trade, or would you be concerned with the big drop that it had today? It looks like that ended up being over 8%. And it had been maybe having some support a little bit along here, about 52 or so. And it looks like here, it didn't quite go down below kind of this area of support here. But I could see some people being concerned that maybe this area that was old resistance that should be new support didn't hold it. What do you think? Should we be out of the trade or not? Go ahead and chat into me. Tell me what you think about that. I've already made my decision what I think about it, but I want to give you some time to just process it yourself. And you can tell the TV or your dog, or if you've got a cat, tell your fish what you think the answer is for you personally. Is it time to get out of the trade? Now, I'm going to say if this was a really, really long-term holding, let's put on some different moving averages here. We're going to put up a 10, a 30, a 100, and a 200. The gray line down here is the 100. The green line here is the 200-day moving average. So today it broke below our 30, our 200, getting pretty close to our 100 moving average. Yeah, your fish says out, Ricebird says. Yeah, close the trade. It's not really doing us any favors right now. We used it for our purposes. We sold a call against it so we could see how that might help somebody in that situation. Overall, we made a little bit of money by doing that, but not a ton. Yeah, it's time to be out. It's broken through support. Perhaps something's changing on it. I did not listen to the report on GM today. Maybe some of you did, and you know what they highlighted, what their misses might have been, or if they said, hey, our forecast for the future isn't as rosy as what we thought it might be. But let's go ahead. Let's close out that position right now. And we're just going to sell it outright. And looks like $48.95 is something like that in that area. We'll go ahead. We'll put that order to go in. Right now, the markets are closed, so it won't execute, but it should tomorrow. And I'll watch it tomorrow, make sure that we do get out of that particular trade. All right, let's look at AMD. AMD, you can see here, pretty profitable on the position on our P&L open. Down today about 156. This was one that we had, let's see here, a longer dated option at the time we got in, which was, let's see when that was. June 11th is when we got in that. So we've been in it for maybe 6 weeks or so. It's done really nice for it. We still have 122 days. in the trade. And we were using it as a stock substitute. And on here as well, we sold a shorter dated option to kind of collect some premium. Now, let's just take a quick look at AMD's chart, and then we'll run through the numbers here. On AMD, you can see this is when we got here in initially, pulled back a little bit, then we've seen higher highs, higher lows, maybe running up into some resistance in that 160-ish area, starting to pull back a little bit. I want to kind of highlight what this candle is. Do you guys know what that candle formation is? If you think you know, shout it out to your fish, your dog, your cat, your neighbor, your computer screen. All right. It's even more manifest as the day went on. Okay. Basically, the stock dropped, AMD dropped down here, and then the bulls started driving it back up, right? By the end of the day, we have what's called a little hammer candle. And a handle hammer at support, and I would say, yeah, that looks like it's right at support. I don't have a line drawn in there right now, but look at that. That was old resistance, kind of getting to that area of possibly being support for the stock. So this is a reversal candle where it looks like maybe potentially it could reverse and head back up. So what did we do? We bought back that shorter dated call. On that one, let's see. We brought in $1.50 when we sold it, and we bought it back for 23 cents. Okay, that gave us 127 net on that covered call, or not covered call, but call against our longer dated call. And so, yeah, it just kind of helps offset, helps you bring in a little bit of premium when you're not really meeting exit conditions, but the position maybe isn't gaining you a lot of ground. And so that's exactly what we did. The reason for buying it back is that it was going to expire this week. We needed to do something, okay? July 25 is when it expired. We only have 3 days left. And seeing that hammer candle was like, oh, well, maybe the next few days are going to reverse. It is going to go up. That's not going to help us. Let's go buy it back while it's cheaper. Made a nice little net, 127, kind of helping it. Yeah, you guys recognize that hammer. Excellent. But does the logic make sense to you as I explained the thought process? Why did we go buy back these calls? What was the purpose? Okay. I hope if we're walking through the process with you, that's helping you as you're trading different strategies and you're trying to think through the process. We did 2 trades last week for earnings. Okay, we need to review them. I'm going to tell you right now. Well, I won't tell you right now. We'll roll it out here. First one we're going to look at was Triple M. Triple M had earnings, and we knew they were going to have earnings. We did it specifically for earnings, but we did it a couple of days in advance. Can you tell which day they had earnings? Okay, here's last Thursday, and we had a straddle on this. So we had a long call and we had a long put. And generally, your expectation is such that you think maybe one of them is going to win, right? If it pops up, you're thinking, oh, better sell my put, go buy it back, or go sell it. Or if it drops, you might think, oh, let's go salvage what I can out of that call because we're going to be making money on the put. This one was tricky. All right, I'm going to go into a 5-day, 5-minute chart because I want you to see what happened here. So let's go 5 days, 5 minutes. And I'm going to back up here a little bit. So, we had been in a couple of days before. Here they announced this gray shaded area is after hours. Okay, so this is during the day when it's trading on the 17th, which was Thursday. And this is the night of the 17th going into the morning. Okay, so pre-market, what's it doing? Oh, it's running up pre-market. Oh, look at that. And then as soon as the market opened up, yeah, it was up fairly high because of this pre-market run. Right at the opening bell, if somebody had been watching it like a hawk, they might have been thinking, hey, our call option is the one that's going to do well. Maybe we sell the put. However, it reversed right away. And I will tell you, I was not watching it like a hawk. I was actually teaching a different class. So I was not watching it whatsoever, but it quickly collapsed and went down. Okay. So with this dropping really steep here and doing it pretty quickly early in the day, okay, you can see most of that drop was in what, maybe the first hour and a half or so of the market being open. A lot of it coming in those very first few minutes. So is it likely that we would be winning on both sides of that one? Not likely, right? Our call is the one that did not really do much for us at all. If we go back to, let's go back to monitor and account statement, and we'll run the numbers here on Triple M. So we initially, for the call and the put, we got in for 855. And that means we need to sell something by the time the option's done for 855 in order to even break even. Okay. Well, after that big old slide, the put was worthless. It was not worth anything. I could not even buy it back for a penny or sell it for a penny or two. It was like nothing. And so what we did end up doing on the 18th, which is the first day it traded, that day we were looking at the sharp drop, we did go ahead and we were able to at least sell the put, make a little bit of money on the put. Okay. We bought it for 450. We sold it for 565. But again, we needed more than 565 to offset the entire cost of this. Okay. So if we do some quick math there, it looks like what? Maybe we lost about, was that $2.90? So almost close to $300 per contract. And we just did one contract. All right. Has anybody ever had that happen to them? It can. That's why some traders feel that it's more speculation to trade over earnings. And sometimes it works out for you, sometimes it doesn't. This one did not work out for us. Do you think our other trade worked out for us? Our other trade, let's go back to a regular chart here. Let's go back to 3 months. The other trade that we did, I told you we did one straddle, which was Triple M. The Iron Condor we did on Pepsi. Okay. Ricebird saying, yowza, you're looking at what maybe Pepsi did. So we drew on our chart. So we knew where our boundaries were. We had the market maker move on. We saw how much it was expected to move. And then we sold a call above that point and a put below that point, with the expectation that what was priced into the move is what the stock would do. And we were hoping it would stay between 141 and 128. It did not. Next day, what did it do? Boom, gaps up really big. Pepsi has some great earnings, right? And it's staying above this 141-ish area, right? Many times the bottom of that gap acts as support, and it looks like it is, right? It looks like maybe it came back and tested it, bounced back up. But on the 18th, that's Friday. And really, let me make sure this is Friday. This might have been Thursday. Yeah, this was on Thursday that it opened on the 17th. Okay. So this side of the equation, where we had our put spread, looking very nice and pretty. But our call spread, it was not looking nice and pretty. Okay. We were in a situation where we were at a max loss. So when you're at a max loss, you think, well, what should I do? Should I close it up? Should I just sit there and watch it? What should I do? And so if you're already at a max loss, can it get any worse? Well, not if you're at a max loss, right? On that side of the trade, it can't get any worse. I mean, it can in the sense that the spread could widen, that is really artificially wide and goes even beyond what your theoretical max loss would be. Okay. And so the decision was, well, let's hold on to it. Let's see if it maybe falls back down into this area. Okay. And so it did. It had a couple of days. This was Friday, and it expired on Friday. So this was the only amount of move that we were able to get out of it on Friday. This, of course, was yesterday, Monday, but the option had already expired. So on that one, we took a little bit of a hit. And, sometimes you feel comfortable holding over an earnings, depending on if you're holding the stock or you put a collar on it. You're taking some protective measures, and you might feel comfortable doing that, or it's something you've held on to for 5 years. and you love your cost basis on it. And you don't care if it dips a little bit because in the long scheme of things, maybe that stock is doing great. But both of these, we talked about them being speculation, and indeed they were, and neither one of them panned out for us. Okay, so the straddle didn't work, buying those two long options, long call, long put, and then selling the put spread, the call spread. That one didn't, well, the put spread worked out just fine, but we did lose on the call spread. All right, any questions on any of that? Let's see, seriously, when we were seriously says, look more to the left to see more AMD support. When we were talking about AMD, I missed that comment, but we can go back and look at AMD real quick here. Not Pepsi, AMD. And go back a little further in time, like let's pull up a 1-year chart. And let's see, yeah, it kind of looks like it was resistance here, and as we head on over here, that does kind of correspond to maybe a peak here back in November. So yeah, that very well, played into it here as well. Yeah. All right, Coke tastes better than Pepsi is what Vic says. All right. Well, let's look at a couple of things. We looked at the market, seeing what was going on. I want to show you something else, and I'm going to share this with you as well. And what I want to show you is something I'm going to blow up here. Some of you have maybe seen this graph before, and it's really all 11 sectors mapped out the last 30 days, what they're doing, and then down here in this bottom right-hand corner, the SPX. And it can give us an idea of, what's the trend for the different sectors, right? And that can help us as well as we're looking for, are things changing a little bit? Now, information technology has been the best performer. And we can see, yeah, it's got a nice little upward trend. If I collapse the graph over a little bit, we'll see that, yeah, in the last month, it's up like 7-point-something%. Okay. Utilities. Interesting that it is kind of trending up here as well. Made a nice little move here. So this is very defensive, right? The utilities is. Information technology isn't really defensive, but man, we have a lot of expanding technology going on. We can see energy is still struggling. Materials had been up for a bit. It's kind of maybe flattening out here a little bit. We'll see. But industrials is still holding fairly strong. And then something that was a little bit interesting here, communication services had been a little bit flat, maybe a little bit up today. Where did it go? Consumer discretionary. It still is in an uptrend. And so as we're seeing different things going on, downward trending here in the consumer staples, that kind of conflicts with the utilities going up because both of those and healthcare tend to be a little bit more on the defensive side. So maybe things are mixing up here a little bit, and there may be pockets where we find bullish opportunities and pockets where we see bearish opportunities. Okay, that was the main point of that. If you would like a copy of that, I'm going to share that URL with you. Remember, anytime we share a script with you, it's never guaranteed as to accuracy or timing. Now, we are going to take a quick break here as I send that out to you because I think I saw a survey. I did see a survey out there just a little bit earlier. And we'll do this from time to time where we will say, hey, what do you think? Share your, give us your feedback. There's 2 simple questions. You just fill in the radio button, plop, plop on a scale of 1 to 10. What are your feelings? We really do want to have your feedback. And then there's another couple of places where you can put in and answer a question. And I'll also encourage you to use that as a place to communicate something to me or put in a request for something you would like to see in this class. And sometimes some of the topics that I cover come directly from what you've put in the survey. And it's interesting because sometimes it'll be 2 or 3 of you that are interested in the same thing. And so, yeah, we'll go out and explore that. So I'm just going to encourage you to fill that survey out. Looks like Cameron's posted that there again. And I'm going to put in this block. Remember, you only need from HTTP over. And the other part of that is my Oh, that's the 3-month one. I'll send that to you as well. That wasn't the one I showed you. I showed you the 1-month one. Well, you guys get a bonus. You get to see two of them. You get two of them today. And those of you that aren't familiar with how that works, take the URL, come up to setup, open shared item, plop it in there, put in that formula, preview, and import. Make sure you recognize or maybe even write down the name of what you called it. Now, one other thing I wanted to point out to you, and this might be more of a learning day as opposed to a lot of trade day. I want to point something else out to you because it falls into our discussion, about are things changing. I'm going to pull up SPX A50R, which tells us how many stocks are above their 50-day moving average in the S&P 500. Okay, so don't worry so much about what these moving averages are showing here because we're looking at actual numbers. So, maybe 3 weeks ago or so, we saw this up maybe at 79 or 80. Okay. It looked like it was kind of pulling back a little bit here until today. Yesterday, it looks like it closed at about maybe, looks like 61.63. So maybe only 61% of stocks were above their 50-day moving average, whereas a few weeks ago it was a little bit higher. But today, there were some stocks that were really strong that caused it to pop up here again. So if we start noticing this kind of sloping down and maybe making lower highs and lower lows, that might give us an idea that, not as many stocks are participating in the rally. Okay, if we start seeing that pattern, that it starts to diminish a little bit. Vic wants the script for the red labels on the top of the chart. I'm happy to share that with you, Vic. I don't have it in my scratch pad. Tell you what, Vic, I will post that out of my Twitter account. Do you follow me on Twitter? After our class, I'll go out there and post it on there because, these little year-to-date labels are really helpful, but it might take me a little bit of time to find where I've got it buried. Okay, because I've got a lot of scripts out there. Okay, let's look at Delta Airlines, DAL. They've been through earnings. Nice. We don't want to deal with earnings right now in our trades. They had apparently some positive earnings, right? We can see they gapped up here and they've stayed. They've stayed up here. This is the 200-day moving average, but it's also a nice horizontal area of support there, about 54.55. In that kind of a scenario where we have a bullish stock, but maybe things are starting to slow down, what kind of a strategy might we target? I'm going to say let's target a bull put strategy, a short put vertical. If we come over here to Delta, pull up the trade tab, it has weeklies. Sometimes that can be a nice alternative. It traded 7.5 million shares today. I'm going to tell you, the strike prices didn't work out that well in the August 15s. And so I went out to the August 22s. They just seem to work out a little bit better, okay, with these $1 strike prices. So we're going to do the 53. And let me show you this. 53, we've got, I guess, 100 contracts here, 192 here, 1,200 here at that 51 strike. That's our open interest column. Let's see if this still makes sense or if I'm going to have to adjust it a little bit. Let's say sell vertical. And on a $1 wide spread, 29 cents is a pretty decent percent return. We'll run the numbers here in a minute. But if you are concerned about the low number of open interests and you're like, I wish I could spread it out a little bit wider and still make a reasonable return, you might consider doing that. So we might consider here going 53.51, knowing there's oodles of open interest here. And if we wanted to say, okay, 51 is our max theoretical gain, would have to divide that by 149 to see what that percent return is. You're going to see it's not too shabby. 151 divided by 1.49, 34%. Okay, so 34% for about 31 days to be left in the trade. So you wouldn't have to spread it out if you didn't need to. If you're doing, say, 2 or 3 contracts, you might feel comfortable enough with this open interest. We're going to spread it out a little bit, and it still meets our objectives. If we can risk $1,500 on any trade in our trading account here, let's divide our $1,500 by a 149. That's saying we could do 10 contracts. Okay, so we're going to do our 10 contracts, and we're going to say, hey, if we get a chunk of that maximum gain, we're going to get out early. So we're going to set this order up. We're going to say create an opposite order. Let's go buy it back when we get, say, 70% of 51, then we'd have 30% left sitting out there. That would put it at about 15 cents. So we're going to go buy this back at 15 cents. We're going to make that good till canceled. And we're going to send that in. And maybe automation will help us out on that. And we're going to put that in our option strategies bucket. All right. We're running a little short on time. So what I may show you is some charts and give you a homework assignment. Okay. A couple of others that I know we needed to do a little bit more instruction and probably less trades today. But another one that you might consider taking a look at here is a stock that's already been through earnings as well, Citigroup. They had their earnings. They popped up nicely. They've continued to kind of run here a little bit. This might be looking like a little bit of a flag, and you could maybe look for a breakout of the flag formation tomorrow or the next day, see what happens there. That might be one to keep an eye on. Different one I was looking at here was Kroger. And with Kroger, they're done with earnings. Great, they're out of the way. They gapped up. They came back, tested kind of a support area, and they've been making higher peaks and higher troughs. And today, kind of bouncing either off this diagonal support, it might look like, or the 10-period moving average. So somebody maybe wanted to target something there with a bullish type trade that maybe you weren't super bullish on because you're concerned maybe about if the overall trend of the market is starting to weaken a little bit. You know, you could consider doing something there. Something we are going to throw in, we'll take the time to do it. We're going to do a bearish trade here. We haven't done a bearish trade in this class for a long time. Okay. What's going on with Micron? It had been a nice upward trending stock, but what are we seeing? Lower peak, lower trough, lower peak, lower trough. Today, it's giving us that close below the low of the high day. That's our first day seeing the kablode. Some traders like to use that as a bearish entry, and their earnings are over as well. So we're gonna do a bearish position here. Again, we don't normally do this a lot. The August 15 options are going to work out for us here, and I was looking now. Let's see if this still makes sense. Let's look at, we're going to do the 115, 116. We're going to sell that vertical. A 30-cent credit, we're going to keep it $1 wide. That's going to give us a little bit better return, somewhere in the high 30%, right, on that. And if we are risking, well, let's do edit here. We can do in this one, we take 1,500 divided by 70. Oh, actually, I did that number totally wrong. I'll position size this after our class is over, and then I'll go ahead and put it in. Make sure it gets filled tomorrow. And actually, we were doing a sell vertical here, not a buy vertical. Okay, that looks better. Probably a slip on the mouse there. So this is what your homework's going to be. The two stocks that I showed you, Citigroup, Kroger, in your paper money account, maybe put together, design your own bull short put vertical, okay? Bullish trade. Tinker with Kroger here, or Micron here rather, okay? For a bearish trade, doing a short call vertical, noting that it had been strong, but now it's showing some weakness in that trend. And we're going to follow up on these trades next week. So that's your homework assignment. In your paper account, experiment with putting those kind of trades together. Cameron, I appreciate your help in the chat today. Cameron will repost that survey. And I'll just encourage you again to fill that survey out. We do appreciate it when you do that for us, and we love to read your feedback. Tonight, this is the last class, but in 15 minutes, we are going to have the Advanced Option Strategies virtual workshop. We're going to be going in for day 2 because it started yesterday. All right, we're going to be going in for day 2, and they're running a great class. You've got Ben Watson, you've got Ray Kimbrell, and I think Scott is there as well. All 3 of them are there running the virtual workshop. So enjoy that. It's advanced options. Those of you that are maybe a little bit more advanced traders might appreciate that because we don't do these nearly as often as we do the basic workshops. Okay, you guys, have a great evening. Appreciate you filling out the survey. Subscribe. Follow us on our Trader Talks channel. Follow Cameron and I on X. Thanks, everyone. We'll talk to you later. Bye-bye.